Good day. The first quarter of 2023 was a tumultuous period in markets, with a fast start in January and then clear volatility in March after the collapse of Silicon Valley Bank, amongst others, in the United States. This led to fears of broader contagion across the banking system and the abrupt acquisition of Credit Suisse by UBS. The US Federal Reserve acted quickly to prevent broader contagion by stepping in to provide support for banking customers as well as liquidity to markets in general. In South Africa, the key story of 2023 so far has of course been the high level of load shedding and its consequent drag on the broader economy. The Fed raised rates in both February and March in an attempt to cool inflation. And these moves were echoed by European central bankers who also lifted rates twice by, I think, 50 basis points each time. This took borrowing costs to their highest level since back in 2007. And in general, though, recession fears receded through the first part of 2023, with increasing talk of a so-called soft landing. Central banks are attempting to cool inflation without causing a recession or a material increase in unemployment. I'm reminded of a quote by former Fed Chair Paul Volcker, who said that unfortunately one of the ways that monetary policy crushes inflation is by causing bankruptcies. So history is not on the side of the central bankers in this regard. We did, however, see US inflation rise by less than expected in March, leading to speculation that further interest rate hikes will be limited. Signal from global bond markets is unfortunately clearly pointing towards an economic slowdown in developed markets in the latter part of 2023 or perhaps early 2024. While parts of the US economy remain remarkably strong, particularly the labor markets, we do see the Silicon Valley Bank collapse as the first crack evident in a stretched system. Recall that it often takes more than a year for the impact of higher interest rates to be seen in broader economies and sort of in Main Street. So we do expect pressure to build through the rest of 2023. In terms of asset class performance, equities did best, with the MSCI World and S&P 500 indices rising 7.7% and 7.5% respectively over the quarter. The Euro Stoxx 50 was the star though, helped by a weaker US dollar that was up 16% in dollar terms. MSCI Emerging Markets Index, that lagged global averages and returned only 4% in the first 3 months of the year. From a style perspective, growth stocks clearly did best. They were up about 15%. While the value and momentum factors struggled on a relative basis, basically flat over the course of the quarter. Global bonds at least performed better than their disastrous 2022. They delivered a 3% positive return in dollar terms in the first part of the year. Commodities, that was more of a mixed bag. Gold was up almost 9%, but oil was down each month through the quarter. Overall, though, the commodity complex lost ground slightly, and we do see that evident in commodity stocks as well. When looking at South Africa, our local equity market lagged its emerging market peers. It was up only 1% for the quarter in dollar terms. The numbers do, however, look a bit better when expressed in rands, with Aussie up just over 5% in rand terms. Within our market in South Africa, industrials performed best. Resources lagged in line with the lower commodity prices, as I mentioned earlier. The gold shares, of course, bucked this trend. They were up 13% over the quarter. Our local bond market returned 3% and cash delivered about 2%. When we look at the money that we manage for our clients, the Houseview equity model's performance is particularly pleasing. Over the last 12 months, this portfolio returned 11% after fees. That's more than 6% ahead of its benchmark and more than 9 percentage points better than its median peer. Certainly, the overweight positions in Prosus and Anglo Gold were among the key drivers of that outperformance. That performance now places the portfolio in the top 3% of its peer group in South Africa over 1 year, and the long-term performance here, which is far more important for our clients, is also positive. Portfolios delivered 11% per year over the last 5 years, and importantly, compared to peers, this portfolio is in the top quintile of its peer group over 1, 2, 5, and 10-year periods. We're quite proud to share that during the quarter, the SPW Equity Fund, which is a near identical replica of the equity portfolio, was awarded a 5-star rating from Morningstar. Morningstar is the leading independent fund researcher globally, and they assess both performance and the investment process behind achieving that performance. So of the 224 equity funds in South Africa that they rate, only 12 have a 5-star rating. Then, in line with the healthy performance of the SA equity portfolio, our worldwide equity portfolio also comfortably beat its benchmark after fees over the last year. That delivered a total return of just under 12%. If we move across to our Regulation 28 multi-asset portfolios, performance here is again pleasing. The balanced, moderate balanced and conservative portfolios are all ahead of their benchmarks over 1 to 5 and 10 years after fees. And importantly for our clients, they're in the top quartile of their respective peer groups over all of those periods. The portfolios in general benefited from the South African equity component, which I touched on earlier, but also saw positive asset allocation calls work rather well. Over the quarter, we moved our equity and multi-asset portfolio positioning to be a bit more defensive. We took advantage of strong performance in shares like Prosus and AngloGold to create cash, and certainly in the multi-asset portfolios, we then reinvested that cash into safe haven US government bonds. Overall, our positioning is now relatively conservative, given our concerns over the impact that the material tightening of financial conditions over the last year is likely to have on future economic growth. Although inflation is clearly slowing from sort of the multi-decade highs that it reached last year, it remains well above central bank target levels. That means that we think that rates will continue to go up. We think there's one more rate hike that's likely to come in May this year. But after that, we expect those rates to be held steady. When we look at global equities, prices are still higher than average on a forward-looking price-to-earnings multiple basis. So essentially, it's still looking a little bit expensive. On top of this, we are concerned about a seeming disconnect between consensus earnings estimates for the US market, which have only come down a few percent, and the way that various leading economic indicators are flashing red, essentially telling us that earnings estimates in the market are maybe a little bit higher than they should be. The next piece is that the VIX, which is a gauge of volatility, and effectively serves as an indication of the overall market's level of fear. That index is at its lowest level since markets peaked back in January 2022. So that suggests to us that the US stock market is maybe a little bit too complacent right now. Turns out it makes us a little bit concerned. If we then turn our attention to the South Africa and our market, we have a substantially different situation. Our market is looking cheap relative to both its own history and global peers. Why is that? Of course, it's the spectre of load shedding that's dampened enthusiasm in our market. With the various sort of PMIs, the Purchasing Managers Indices, those are certainly moving in the wrong direction at the moment. Unfortunately, a portion of the negativity is actually justified in South Africa. We are, however, starting to see one or two interesting opportunities in our home market where we think that the market in general is pricing in too much negativity on certain shares. So we're starting to get a little bit excited there. It is worth reminding viewers that also that about half the profits generated by JSE-listed companies, those are generated outside of South Africa. So it's not as dire on the stock market as it might be on Main Street. After the solid start to 2023, as we look ahead towards the rest of the year, firstly, we're fully aware that the future is uncertain, but that's always the case. What we do see, though, is that asset prices around the world are within range of being reasonable at this time, certainly a far cry from early 2022, when almost everything looked expensive. Our focus at the moment is on the progression of the economic cycle, and unfortunately that appears likely to deteriorate over the coming quarters. And that's why our positioning within our client portfolios is relatively conservative at this point in time.